Here are even more investment principles, emphasizing deeper, niche, and often underappreciated insights. 1. Understand capital allocation. Invest in companies that intelligently reinvest profits or return them to shareholders. Henry Singleton. 2. Embrace optionality. Favor investments that offer multiple pathways to success. Nassim Taleb. 3. Study historical context patterns in history often repeat. Learn from past market cycles. Ray Dalio. 4. Beware of growth at any price. Fast-growing companies can become overvalued quickly. Growth doesn't always equal profitability. Charlie Munger. 5. Focus on owner-operated companies. Businesses run by founders often have a stronger focus on long-term value creation. Nick Sleep. 6. Understand secular versus cyclical trends. Distinguish between short-term cycles and enduring changes in industries. Howard Marks. 7. Embrace concentration. When conviction is high. A few great investments can outperform a diversified portfolio. Chris Davis. 8. Don't confuse activity with productivity. Frequent trading often reduces returns due to fees, taxes, and emotional errors. John Bogle. 9. Look beyond consensus forecasts. Market prices often reflect the consensus view. Contrarian insights generate alpha. David Einhorn. 10. Focus on companies with pricing power. Invest in businesses that can raise prices without losing customers. Warren Buffett. 11. Be skeptical of turnarounds. Companies in distress often struggle longer than expected. Peter Lynch. 12. Track insider selling. Heavy insider selling might signal trouble even if fundamentals look sound. Joel Greenblatt. 13. Avoid complexity bias. Some of the best investments are straightforward businesses. Don't be lured by complexity. Walter Schloss. 14. Focus on return on capital employed. ROCE. ROCE is a critical metric for understanding how efficiently a business uses its capital. Terry Smith. 15. Don't ignore the power of small caps. Smaller companies often have higher growth potential than large-cap counterparts. Peter Lynch. 16. Beware of dilution. Excessive issuance of shares can erode your stake in a company's growth. Howard Marks. 17. Macro matters, but micro wins. Understand macroeconomic trends, but focus on individual companies' fundamentals. Stanley Druckenmiller. 18. Look for hidden assets. Some companies have undervalued or unrecognized assets, such as real estate or patents. Monish Pabrai. 19. Volatility is not risk. Don't equate price fluctuations with risk. Focus on permanent loss of capital. Seth Klarman. 20. Understand incentives. Pay attention to management's incentives and how they align with shareholder interests. Charlie Munger. 21. Be wary of debt-heavy companies. Excessive leverage can amplify losses in downturns. Paul Singer. 22. Look for consistent innovators. Companies that continuously innovate tend to stay ahead of competition. Jeff Bezos. 23. Adapt to changing market conditions. Rigid strategies often fail in dynamic environments. Flexibility is key. Ray Dalio. 24. Understand network effects. Companies with strong network effects, e.g. platforms, can dominate markets. Reid Hoffman. 25. Invest in pain points. Successful companies often solve critical problems for customers. Mark Andreessen. 26. Look for secular decline opportunities. Distressed industries with solid underlying companies can present value plays. Carl Icahn. 27. Watch currency risks in international investing. Fluctuations in exchange rates can significantly impact returns. John Templeton. 28. Behavioral trends drive markets. Understand how human psychology, fear, greed, and biases shapes market behavior. Daniel Kahneman. 29. Take advantage of forced sellers. Forced liquidations create opportunities to buy quality assets below fair value. Howard Marks. 30. Focus on incremental gains. Small, consistent improvements can lead to substantial long-term wealth. Tony Robbins. 31. Understand the role of technology. Technology is a key driver of economic change. Invest in businesses leveraging it wisely. Peter Thiel. 32. Follow demographic trends. Aging populations, urbanization, and other trends offer long-term investment themes. Jeremy Grantham. 33. Watch cash conversion cycle, CCC. Companies with short CCCs are often more efficient and resilient. Pat Dorsey. 34. Evaluate disruption risk. Avoid industries at high risk of technological or regulatory disruption. Bill Ackman. 35. Learn to let winners run. Don't sell high-performing stocks too early due to fear or impatience. Peter Lynch. These insights emphasize deeper, specialized knowledge and strategies that can sharpen your edge in investing.